What's the first thing that comes to mind when the stock market is mentioned? Is it those guys on Wall Street's busy trading floor? Or big businessmen in suits and ties? Maybe even think of investing as a way of gambling money away. If you identify with any of these descriptions, then this video is for you. Most people's perception of the stock market is made up of false ideas that are so commonly accepted that you'd think they're true. I'm going to address these misconceptions and tell you what the actual truth is. So stick around and you could learn a thing or two. Welcome to The Eighth Wonder, a channel dedicated to making compound interest your best interest. Most of the misconceptions I'll be discussing here are normally people's opinions which they formed after going about investing in the wrong way and getting burned, or from someone who knows somebody who got burned. So listen closely to avoid being the next victim. The first misconception, and probably the biggest one, is that investing is for rich people. This can be very easy to believe when you see all these ultra rich people who own huge amounts of equity in the big companies and have very impressive portfolios. I guess you can say that there are a lot of rich people who invest in the markets, but that doesn't mean that you have to be rich to be able to invest too. It has never been easier or cheaper than it is today to invest in the markets. With the right tools, anyone can do it. There are a lot of platforms that offer super low brokerage fees, are super easy to use, and offer a low barrier to entry. This means that you don't have to wait until you have a lot of money for you to start. If you start with whatever amount you feel you can afford and put it into a good investment every month, you can grow yourself a nice little nest egg over time. Those rich people you might know who do invest do so because it helps to preserve and grow wealth. But for someone who is just starting out, investing is a way to start building wealth. When it comes to investing, a little can go a long way. If you'd like to know how to start building wealth on a low salary, then the video linked in the description is for you. So make sure to watch it after this one. The second misconception is closely related to the first. It is the idea that you need a certain amount of money to get started. This could not be the furthest thing from the truth. I mean, don't get me wrong, starting with a substantial amount has its advantages. But when it comes to this, consistency is better than intensity. What I mean by this is that it is better to start small and consistent than to wait until such a time when you have a lot of money for you to get started. As I've already indicated, there's virtually no barrier to entry. The little that you can afford to put in every month makes a difference, especially when you're committed and you make sure to increase the amount you put in whenever you're able to, like when your salary increases. This habit of consistency is known as dollar cost averaging, and it is a simple but very effective strategy to employ. The thing about this is that at first, it can be quite disheartening because the growth is quite minimal, so you have to stick with it for quite a while before you can start seeing results. I've personally seen how this method can work to one's advantage. Had I chosen to wait at the time I got started, chances are I could have still been waiting to this day. So, having seen it firsthand, I can tell you that you don't have to wait. If you happen to be waiting, then I would encourage you to get started. The third misconception is that investing is a fancy way of gambling. Sure, there are people who find ways to gamble on the stock market, but when they do, it's called trading and not investing. So, what then is the difference between the two? Well, I'm glad you asked. See, when you invest, you are buying a piece of a business that you have reason to believe will do well over time and give you value. But when you gamble, you are making a bet on the share price moving one way or another. You're relying on probability. Another difference is that when you invest, it is with a long time frame in mind. You look at the value of the company, not just the share price, and you make informed decisions. Whereas when you gamble, it's usually a short term thing. I honestly feel like all these instruments that are now available to use on the stock market are the reason why the lines between investing and gambling have become so blurred. But I can assure you that they are very different, and a lot of it comes down to our view and what we're trying to achieve. The fourth misconception is that investing is too risky and that it is better to put your money in the bank instead. Society has normalized the idea that keeping money in the bank is a good idea. People most often feel like having lots of money in the bank will give them financial security. I mean, sure, it's better than not having any, but beyond an emergency fund in an account with a decent interest rate that also offers liquidity, it's not such a great idea. Most bank accounts don't offer very good returns, and if the interest rate is lower than inflation, then you're actually losing money because your buying power gets eroded every year. To add assault to injury, the bank will still charge you fees for that account. So then, how does investing fare in comparison? Well, the market generally does better than the rate of inflation, so that's the first win. On the lower end, the markets average around 7% per annum in returns, which normally will still give you a positive return after accounting for inflation. The second win would be the fact that with the low cost investment platforms I mentioned earlier, investing is much cheaper to do, which means that your money doesn't get eroded by fees. The third win would be dividends. With this one, it'll depend on what you invested in. Not every company pays them out, but for those who do, that's another component that helps you grow your money. Now, with all this being said, we can't ignore the fact that you can lose money in the markets. This usually happens because of speculation and hype, where people put money into the current hot stock without fully understanding what it entails. Then, when the market sentiment changes and the stock price goes down, they sell. An interesting fact about investing in the markets is that no profit or loss is set in stone until you sell. The market is known to go up and down in the short term, but in the long term, the trend is always upward. So, yes, your money in the bank is insured up to a certain value depending on the laws in your country, but that doesn't mean that you'll get great returns from the bank. The fifth misconception is linked to the fourth. It is the idea that the markets always crash and are therefore very risky. It's true that markets do crash and people do lose money, but it doesn't happen very often. And when it does, it happens at varying degrees. As I've mentioned earlier, most of the losses come from people's reactions to the crash and not so much the crash itself. As an investor, it is important to understand that after doing your due diligence, if you have reasonable belief that a certain company will do well over time, then it wouldn't make sense for you to sell its stock when it goes down due to markets being down generally, or when the share price is dropping because projections weren't met despite the company doing well. As an investor, your mindset is everything. Where some people see distraction, with your due diligence, you can see opportunity. You know how people get excited when there's a big sale at their favorite store, like on Black Friday? That's how you should view the drop in the markets. When the share price goes down, it's an opportunity to buy more at a cheaper price. Unfortunately, for most people, we do things the opposite way, which loses us money. This behavior is best described in this quote by disciplined financial planner Colin Roche. The stock market is the only market where things go on sale and all the customers run out of the store. We get so concerned about losing money that in our efforts not to lose it, we end up making decisions that actually lose us money. Kind of funny when you think about it, isn't it? Not so funny when it happens to you, though, which is why a lot of people want nothing to do with the stock market. Most have made this mistake and got burned, and now they're convinced that the stock market is a terrible place to try and make money. As I've said before, the stock market's long term trend is upward, so you're better off holding on to your stocks or buying more and holding it until the price catches up again. This is an approach that I've often used and has produced some wonderful results for me. The practice of buying more when the market is down is commonly referred to as buying the dip. It can be a very powerful tool in growing your investments. Historically, some of the best performances in the stock market have come after huge drops. So remember that next time there's a huge drop and you feel like panic selling all of your investment holding. The sixth misconception is that you need to time the market and buy at the perfect time in order to make money. This is probably one of the worst ideas that exist when it comes to investing. You'd have to be psychic to be able to see into the future and make this idea work. People often keep track of a certain stock, waiting for it to either go up or down to a certain level before they buy. The chances of this happening are quite slim. When looking at the opportunity cost of this exercise, you're better off following the adage, time in the market beats timing the market. The time you spend on the sidelines is time that you could be making money through a simple approach like dollar cost averaging, where you consistently invest into the market over time. This is another strategy that I have seen working for me. If you're going to time the market, the question is, how long are you willing to wait for your desired entry point to appear? If you look at the markets for the past 3 years, there's been a lot of talk about it being overpriced and a correction being imminent. But despite all the talk, it has continued to go higher and higher. Had you waited for it to crash, you'd probably still be waiting to this day. There's a quote that is attributed to popular economist John Maynard Keynes, which says that the market can stay irrational longer than you can stay solvent. And for the past 3 years, this has been testament of that. Dollar cost averaging into a low cost diversified index fund will most likely do more for you than trying to predict where the price of one stock or the other will be in the next 2 weeks. The seventh misconception is that you have to be super smart or be a financial expert in order to get it right. It's easy to feel intimidated when you see all the big finance guys talking about the markets and feel like you're not qualified or smart enough to invest with them. There's a lot of information about what's going on in the markets that's flying around everywhere. It's widespread and therefore has a lot of attention. Most of this information is just noise. It's not important for you to know all of it. You can do very well without doing a deep dive into all these different indicators to know what you should invest in. There are a few things that are beneficial to understand, and those things are found in a company's balance sheet. Investing legend Peter Lynch narrows the criteria for investing into a company to this: more debt than income is bad, and more income than debt is good. All of this is public information, so a quick internet search will help you bring it up. Here's an interesting fact. In 2007, Warren Buffett made a bold statement that would lead to a $1 million bet. He claimed that over a period of 10 years, the S&P 500 index would outperform all the portfolios held by professionals in hedge funds. In 2008, Tom Siders of Protege Partners took him up on the challenge, and it didn't even take the full 10 years for Tom to accept defeat. This proves that the average person can make it big by keeping things simple. The secret is what I've already spoken about: consistent effort and patience. You don't have to take advice from the gurus, you can figure it out. It can be as simple and as consistent as investing in those low-cost diversified index funds like the S&P 500. The stock market is a wonderful place for companies to make money, and it can be a great place for you to make money too. In order to do so though, you have to be aware of all these misconceptions so you can avoid them and do the things that will provide you with real growth. Which one of these misconceptions have you been holding to, and what are you going to do about it? I'd like to hear all about it in the comment section. You don't have to subscribe to all these misconceptions, but you can subscribe to this channel and ring the notification bell to keep learning how to build wealth through the stock market. If you found value in this video, then please leave a like and share it with a friend. Thanks for watching. I hope to see you on the next video, but until then, stay invested.